Right there. Look at what is going on. One touch, two touches. I was looking at the significance of this as so much as I don't know, it auto-populated somewhere like this. And I was like, oh, okay. Just probably make these lines a little bit brighter so we could look at them today as we get going over here. And whatever. 87, 89. It's what the kids say? 6, 7. What's going on, everyone? I hope you're well and doing great as we get ready here. Are we entering the melt up phase? We're going to look at a few different charts and we're going to talk about a lot of macro and we're going to put it all together. Look at this, though. This is a beauty. Breakout retest over here. I'm starting, just checking out what's going on with the structure just to get a look at it. And then I'm going to just bring this down a little bit over here. And I got to see what was going down. Oh, look at that. Because that touch over there attracted my eyes. And you can see, again, clear structure. Look at this forming the support off of it. I'm going to just bring it down a little further and see what was going down a little bit further. And, well, there's the crash of the 2000 and great financial crisis lows. And there's a little bit of structure there. There's a lot of structure there with the touches all coming into it. If you were looking at this, would you I mean, is this, and then this is the nail off of the lows over here coming out of the great financial crisis. Are we headed towards a market crash? Certainly looks like it to me, except I would say that the timing of when that crash happens is actually what makes or breaks just about everyone on the planet. Because if the melt up phase is here, it's likely just beginning. So we got a lot to talk about. Let's just get into here and let's just be ready for everything. And that's pretty amazing. I would say that that's definitely two nice touches confirming the initial placement of this over here. And then what that means is that we have a breakout, a retest, and a resumption out of an upward sloping trend line. And everyone here at CTM knows that when you have a breakout of an upward sloping channel, and it's not any different when you have a downward sloping channel. When you have a downward sloping channel and you have a breakdown, that breakdown usually leads to accelerated decline in price that either leads to an absolute crash or winds up being a liquidity grab. It's the inverse on the upside. In an upward sloping channel, when you have a breakout, what normally happens is you see accelerated price behavior. Is this actually the melt up? You all know back last year throughout 2025, I kept showing the track of 1997 and 1998 on the S&P 500. And the reason for that was that those 2 years had 20% gains in a row, back to back. And then we were looking at the previous 2 years, 2023 and 2024, with back-to-back year. The track still holds. Is this a fractal of the great dot-com bubble into the bust? I mean, is it market behavior playing out again, or is this time different? This over here usually leads to accelerated price. Now, if this is actually a melt up, it's going to go a lot higher than people believe. And I think people targeting right now things like 7,700 on the S&P 500 makes a lot of sense. And we'll talk about that, but I don't know that that's a melt up. Could be a liquidity grab. If that's all that this had into it, getting back below this line would be a devastating technical event. We'll have to continue to watch that. Now, with this in mind, it should just probably be a quarterly chart, not even a monthly chart, but here we are on the monthly, and it's pretty impressive to see. This was the hoopla of the Hormuz Strait affair, and it was a retest of a breakout of a massive upward sloping trend line. When I say massive, going back 100 years. Interesting. Looking at the S&P 500, that's what we're just looking at, but I just want to look at it from a different view. And I'm looking at this just from the great financial crisis and then coming out of it. So it's a different structure I'm looking at, and we're saying to ourselves on the monthly time frame, we just validated the structure that's here. This parallel channel that has been going on here for over 100 years since the Roaring Twenties top to the Great Depression bottom, and you could see that we finally have broken out of that structure. And notice how the dot-com bubble top was a perfect touch. Here's the parallel. Here's the bottom support line. Here's the touch confirming the structure. And then notice at the dot-com bubble top is where we pop it. We touch it. We touch it and then go into the massive correction, then leading up into the great financial correction. That's a double top, my friends. Taking out liquidity grab. Oh my goodness. Look at that beauty. And this is what we're focusing in on now, this track. All right, this is the bigger picture. Now I want to focus over here on what's happening since. And so we're looking at that, and there is a new structure that took place. And look, this one is well, here's another structure since the 2022 bear market, but I'm focusing over here at the great financial crisis bottom, and then the global lockdowns bottom. And you could see that that structure is confirmed here. Here's 2 touches, 3 touches. On the top side, you can see top side here. Like, granted, if I move this down just a nudge, these touches, 1, 2, 3, and then put it back up. It's structure, it does it. And what this suggests is that we threw out a number. I threw a number. The number was like 7,700. And you could see that's an important event. Getting to 7,700 on the S&P 500. Why a lot of people might use that as a marker for what the melt up might lead to. You could see that that is the structural top. That's the top that we came into after we saw the printing presses running, and then we saw QE running. And then when they wound down QE, that was the top that was put in. That's over there. And then I have over here, I'm just going to come down from the monthly. I'm going to look at now a daily chart and the tighter structure that we're in and what that looks like, and to see if that gives any targets that are different. And it's a little bit lower. And then the high one over here. Yeah, that, so you could see in that zone, in this zone, we would be, I would think, very, very overheated. And I would be watching what happens around that area. But here's the thing. And many of you, some of you know what it was like during that hot phase in the dot-com bubble. I remember I would like see a magazine cover about Netscape, and then I'd be like, "Oh, that's a good stock," and then the thing would be up like 300%, and like anyone could pick a stock because the market was going bombastic. We're not there now. We're not even close to that. Some of you might remember what that was like in late 2017 when it came to the altcoin market. Just seeing stocks going up 10, 20. It was at that's a mania phase. We're not in a mania phase or anywhere close to it. But if this melt up is going to take hold, it could lead to it. We're going to go ahead and continue to put this together. Let's just jump over to the NASDAQ really quick. And the NASDAQ here, you could see, is getting towards a very important level. We've been screaming up. Screaming up. Have we come too far too quickly? The situation remains with the Strait of Hormuz closed. I would say that the market is saying that they like how it's being handled, but we all know that's someone holding a grenade with the pin out, and in any second that could blow up, and we could see the price of crude continue to skyrocket upwards and have tremendous damaging effects. Nevertheless, right now the market is saying we could absorb oil at $100 for now. Look, I don't know what the next 30 days looks like, and I don't know what the next 60 days looks like, and I don't know what tomorrow looks like. All we could do is do our best to have situational awareness around us and stay on the right side. but you have to be there to take it when it comes. And that's on both sides. You have to be able to pivot like that if necessary. So I would say that, well, we're coming into some pretty important resistance right over here. Let me just go ahead and highlight that bar a little bit so that I'm watching it a little bit further. That looks like pretty strong resistance, and we've been coming in hot and heavy to it. I wouldn't be surprised to come back and backfill this and see if we could test that as support. And if it doesn't hold, then we're coming back towards the breakout. All of this is in play. Do not get comfortable whatsoever. Crude oil still trading at $102 a barrel. Watching the 10-year and long-term yields to see if they break out, and just that could be devastating to the current market. We finally got some data. The first time since the war broke out that I'm even like, okay, we could even just glance at the data. Job market remains resilient. That's all I could say about it. And the ISM services, it came in okay. I'd like to see the services growing. We're seeing manufacturing PMI growing, and this is since the war broke out. And we're seeing this time, we're seeing Bitcoin and crypto leading with tech, or moving with tech, which is pretty powerful. Tech is expected to lead as the Fed began raising its balance sheet, and then Bitcoin several weeks later was expected to stabilize and then continue its ascent. And we're seeing that take place now. That's pretty positive. I like that data point. I like that view. Looking over here at the dollar, I mean, devastating breakdown. I guess just awaiting what happens with the end of the current situation. And the Bank of Japan is out there just burning money, intervening in the markets. And I wonder, is the next move above 160 the one that takes it significantly higher? And I'm looking over here in this bubble, in this area over here, that I would not be surprised. And just so I have my awareness about me, I'm going to move this over here. Look at that structure all over the markets. And it might just be another structural higher high and not an explosion. That's the problem with horizontals. That's the problem right there with horizontals. I'll just use my mouse over here. You can see the break above, nothing. Breaking above again. It's probably just something that takes us into that zone over there. That's what I imagine. We'll find out. We'll see. Bitcoin trying to hold the breakout above the bear flag, the bear channel. Remember last time it came in short and then sold off hard. This time it's breaking about above. On the daily here, we want to see that breakout hold. Very, very, very important. If it does, here we have it from the inverse over here that we were watching, the breakdown, the retest, and now resumption down. If it does, I would expect that there, I was just first checking out. My eyes are going to the left, and I'm looking at the chart where we just, and it, I don't really see any support, which is resistance. So I think that if we close above, there's a good chance that we could be targeting down over here towards the 87,000. For just so you know where I came up with that level and what we're looking at, or this is actually a lot more accurate. So I'll just come over here. This is, I'll zoom out. I'm going to go to a larger time frame. I want you to see where those three structural lines are coming from. You could see down over here during the regional banking crisis, right after, I'm sorry, this is not the regional banking crisis. This is right after the intern leak about SEC spot ETFs getting ready to launch. This was the grayscale court decision that allowed for the rollover into the spot ETFs. And this was a liquidity grab down over there in September. That's just a one touch. The line above it is really where the support was able to take hold. So that's the line that I want you to look at. This is the one touch. This is over here. It's coming in at about $87,000, which is why I gave the number 87 when I said that if we break down, that's the likely target, and I put the yellow line over there. Now that's the likely target. this is an important view, and this is looking at the previous cycle high, and we wound up. I mean, how lucky could you get? And then I'm just looking over here, and you could see that this is where the bodies formed, and this is where the top formed. I had it set off the bottom. Oh, I mean the top wick over here, and like this. Like this is how I set it. These touches, that touch, that wick, and it's a zone. And we're not out of the woods yet. It's looking more favorable though, right? And then I wonder, I mean, does it ever get easy? That's a big one. That's the 87. I just want to see if this continues. 'Cause I don't know if it does or doesn't. And I mean, I don't know. It's hard to argue. Oh, that's the death blow right there. It does, and it goes all the way to the top, that structure. So, yeah, I mean, just pain points on the chart, and there's a lot to get through. You got to get through all of them to get into price discovery. I'll keep this here with the closest one. We're right into it today. So, although it looks to me like we're kind of clear, we're not. I mean, it looks like we're clear that we definitely have a breakout, a retest, a resumption in effect. We're trading above the structure of the bear flag. That's all positive, but you can see that it never gets easy. And then we have the breakout of Bitcoin versus gold that is being confirmed right now. And we'll continue to watch for when STRC goes on the bid once again. I wanted to get into some charts over here with you on, yeah, mid. I, I'm with you. I mean, I didn't expect a 55% correction during that mid cycle. I didn't expect that at all. And it could have been much deeper, obviously, because I didn't expect it outside of the liquidity event. And if this were a liquidity event, I view a liquidity event where the Fed needs to come in and start printing to address it. And in this particular case, is reserve management purchases at $40 billion a month coming back in, and it's not outright QE. And for sure, there was a reason they had to stop QT and start running the balance sheet the other way. But it's not what I was putting out there as what I thought would be the most likely outcome or even close. I didn't think that we would break below. Trying to find a chart right here. Hold on one second. I got it right here. I didn't think that we would break below over here. 67,000. And we traded as low as 62,000. So that, I was off. I didn't think we would trade below this line. I didn't think we would trade below 75 outside of a liquidity event. And I thought that was the final buffer. And now I guess, since I was so wrong, I mean, you can see how the structure just pinned down again. And if we break that, that would lead to further downside. So got to keep it up going over there. I appreciate the loves, the likes for being here today. If you're here and you made it this far into our session, go ahead and light up that thumbs up. I really appreciate it. A couple of things worth talking about. This is coming from a thread in the New Market Wizard book about a guy named Kirsten and taking $5,000 to $100 million. And then I think he lost with it. I mean, he lost 60% once he got to the 100 million. And that's an important lesson. He thought, first of all, I mean, unbelievable. This guy was working at a janitor at one of the NASDAQ buildings or a security guard. He might have been a security guard or a janitor at one of the NASDAQ buildings over in Europe. And he got interested in the markets because of it. Here you go. The NASDAQ building in Stockholm in his college days. And he was really attracted to what was going on. And he was able to save up $5,000, lost it all a few times, got back in, finally pulled off a massive run. And then you could see that he returned 1,000% in 2020. turning 3.5 into 36 million. Went to 100 million, and then he lost 60% of it in 8 months as the bear market hit. Talks about what went wrong and how he stopped seeing the market. Pretty incredible feat without any 4 major mistakes, right? And this is really important for each one of you. No clear setup to trade. You don't trade just to trade. Lack of situational awareness. He wasn't ready for the bear market, right? And that obviously caused that, along with when he was at 100 million, he was picturing in his mind 6 months later he's at 200 million. Like, it's just normal. That's what. And because of that, and because of being caught off guard by the macro, taking positions too large for their account. Could anyone relate? If you could relate, raise your hand. Over trading in a bad, these are all so basic and paramount at the same time. If you remove those 4 things, and I would add one more, as systematic traders, abandoning your system. No, the moat is not broken and it's about to explode. The importance of, I would say, abandoning your system, and or not taking every trade, and or not diversifying amongst templates, following a winner. You guys know I've pointed out a lot what a bad move it was by Buffett to be in such a heavy position into cash, earning yield on bonds, a devaluing asset. And everyone talking about he's holding $320 billion of cash. And I'm like, well, at 2020, when Powell started printing, he was holding 160 million. He never put that money to work, you know? And you could see it over here. This is a great visualization right now. The cost of non-participation is gapping wider right now. S&P 500 dramatically outperforming Buffett. You could see during the April 2025 crash, looked great. And I bet during the 2020 crash, it looked great. But I bet if you take the two from 2020 March bottom until now, woof. Anyway, I like to visualize it. Yardini, if you never seen some of the charts Yardini puts out, just search Yardini charts and check out the massive amount of candy that there is there. Go ahead and pull it up on a tab right now as you listen. Yeah, this could turn 54K Bitcoin is not cheap. Oh wait, it is cheap. No, that could turn up in a second. That turns up if obviously the situation has no ending, and then demand destruction becomes very real. And if demand destruction becomes very real, it's going to have consequences first for the globe and then for the US. And when that happens, this, guys, one factor here though that is really important. I'll touch on that next. Let me just, like, when we melt up, what are you talking about? Well, the technicals are pointing to it. And then what we have, let's go ahead and just, this is, the stock market balloon is climbing higher. Yardini, by the way, do you remember in January of this year, I put out that chart of the S&P 500 and it had the levels like this of every year. And I was like, you know, I don't know if we go up or down first, but if we get moving to that bottom, are you there? Are you a buyer? That was from Yardini. I gotta get the green going over here just for fun. So earnings continuing to rise. Guys, CapEx, this market is being driven by CapEx spending, and that CapEx spending is going from dramatically higher than last year, and expectations into next year dramatically higher. $1.1 trillion in CapEx spending estimated for 2027. If that stops at any point in time, of course, that's one of the red flags we're watching. We're watching right now, CapEx spending pullback, major red flag. This is being driven by CapEx spending. Another red flag, oil above 120 and the situation getting worse. Major market event that's going to have, that's going to have consequences. That would likely also be the cause of yields blowing out to the upside, and that also would have consequences. Those are the things that we're watching. By the way, do you remember when Janet Yellen, before she left, told us that Treasury buybacks were going to be like $20 billion and that they didn't forecast them to increase? They're now up to $164 billion. That's a lot of money. That, as we said, we're going to see that increase. The dynamics are now in place. We continue. I mean, there is yield control curve running at some form right now as they continue to issue on the short end. They continue to use money to buy back on the long end. I mean, I don't know how many people are paying attention. And then we have one of the major factors, another red flag, another force that is pushing this market is, of course, we've talked about the buybacks, the corporate buybacks, and then it was brought up by Dog and Nation. He said, "Well, listen, as these hyperscalers have to take on debt, if they start pulling back on their buybacks, that's going to be something that could derail this move. 100%, that could easily derail this move. That's something you need to watch out for. But so far, 2026 corporate buybacks all-time highs. That trend likely continues. It is, let's say, artificial engineering of stock market price. If it didn't, yeah, that's bad news bears. It's going. On top of that, you have a job market that's so far remaining intact. And because of that, the passive flows that come into the market through people's retirement accounts is a major force as well. Then you have if the capex spending pulls back, that's a major red flag. Passive flows stop, that's a major red flag. Buybacks start to regress, earnings start to regress, but none of those things are happening right now. None of those things are happening right now. The alarm that we have is, yeah, oil's very elevated. All right, you could see this move, as you all know, is being led by the semis. And a lot of people point to Cisco and the dot-com bubble, but at this particular moment in time, you're looking at massive, massive revenue. Look at that. The 2024 revenue, 115 billion. Projections for 2029, it's just a projection, is 568. Look at that massive, massive increase over there. This is, people looking at, well, guys, this is being led by the semis, and it's not a healthy market. And if you look how many few stocks are above their 20, 50, and 200-day moving averages, you have to keep an eye on market breadth. And that's absolutely true. There's no doubt about it. But I'm going to argue here. I'm just going to point out, this is for the bullish case, that every time a big move started, every time, like the participation between percentage of stocks above their 20-day MA, the 50-day and 200 were all extremely low. And until they got to, above 70%, that's when the bull was able to start actually running. So I would argue, yeah, the breadth is terrible right now, and that could be a negative divergence sign. And you can let's look over here, market crash, right? And you could see that they were very elevated prior and started coming off. I want to just try to get this as accurate as possible. They were pretty low ahead of time, not coming from low and rising. It's just one data point. It doesn't really mean too much to us. That's the only one I have on the chart that I could really look at. But I think that's worthy of looking about what's happening. My point is, yeah, the breadth is terrible right now. Which way is it going to go? Are we going to see an improvement as the market rises? Does it lift all boats? Or are we going to and by the way, there's great reason to see certain the semis leading. They're making right now a ton of money. Moving over, and you could see this view over here. This is so like hat tip right over here to North Star. This is what inspired me to look on the SPX this morning at putting a upward channel over there. And same thing, same exact analysis, different chart, different view over here. So this is the 2000 bottom, and then coming up, I have to look at that. I want to take a look with y'all at the 2000 bottom. I'm intrigued. I need to see what that is saying. Let's take a look here together. And let me put in the SPX. And then let me go to the monthly. For now, when it crashes, it's going to crash. When all of this crashes, guys, and that's a worry. Is it possible that we could go from the situation we're into today, and then we see an actual productivity boom led by humanoid robots and the current advancement of AI? Yes. Is it more probable that we see something like SpaceX IPO, Anthropic IPO, who knows, maybe ChatGPT IPO, and that is basically looking back market liquidity event, and we enter into the transition of what will be the AI age? Yes, that's also extremely possible. It's why I have this chart over here. I want to come back and line up that line in 1 second, but that I have it lined up, as you know, right here. Dun-dun-dun. From the bottom of the great financial crisis. He's lining it up from the dot-com bubble burst, which has me intrigued. Maybe I read that chart wrong because I don't see that. Hold on. Yeah, sorry. He also, okay, this is awesome. He just, I mean, this is the chart I was showing on the ES and SPX just put into one. So he's got our line here and this line here. Fantastic work. I love it. And, but this top line here is confirmed by the touches over there as well. So love it. Love it. Love it. Love it. That's awesome. That was the first I heard of him, I believe. And then this chart reminds me of this chart. And is this chart correct? Is it right? So topping in 1999, I'm going to argue that the majority of the move, or a massive part of that move, came. I have it right here. There you go. This is lining up. I mean, I don't know if it's Grok checked it out and said, yeah, that aligns very well. This is where we are now compared to the peak of the dot-com bubble. And you could see that, well, half of the move, well, not half of it, 40%, 35% of the move still to come. That's massive when you look at it through that lens. And then where was I, y'all? Because I was, oh yeah, back over here. So I would argue that, well, to miss the top 35, 40% of the move, well, that wasn't really that right. And you could see to 2005, we saw a nice move from 2005 up to 2007, 2008. It's kind of where we found the lower end over here. And we ran straight up to 2019. That's pretty darn accurate for something that was supposedly put out 100 years ago by a farmer. So I would say that's incredibly accurate. But I would say that, well, it was in 2019. It was 2020 where market topped in February. January, February, and then, yep, that's when we bottomed right there in January 2023. There's a top in 2026. Are we there right now? And are we about to hit in? Are we going to have a melt up? And is this 2026 like 1999 and 2019, which were off by a year, but significant? And are we going to top in 2026 or do we top in 2027? Or does it matter? Because between now and 2032, we're going to have a massive deleveraging event. And you can make the case for that as easy as day. I don't know. All I know is today, to be on the right side requires being on the right side. And here we are. By the way, strategy holding an open 29% now. Absolute banger. Everything here except TQQQ participating, falling into profit. Guys, we're going to navigate this together. And we're going to make sure that regardless of what we feel is happening, that we stay on the right side, keeping a strong awareness about us. Together, hive mind, collective collaboration, conquering the markets. Everyone, thanks for being here. Great to be with you. If you haven't, on your way out, go ahead and hit the thumbs up. Greatly appreciated. Lots of love. God bless you. See you all tomorrow.